What's up? I'm Dan Fredenberg, and this is another chance encounter. Hey, what's up? I'm Dan Fredenberg. I'm a commercial real estate guy. I'm from the internet. We're seeing more properties like this being built in front of a house that's going to be torn down soon. I understand that there are power lines that are getting kind of close. What's up again? This is Dan Fredenberg, and that there is a commercial real estate building. I'm joined today with Ryan Elsey. We've been going back and forth on LinkedIn for a while, so I'm really excited to meet you. How you doing today, Ryan?
Not too bad, Dan. How are you?
I'm fantastic because after all, I don't know if you know about this, but today my very favorite audience member is joining us today. And why is my favorite audience member here? It's because this is a chance encounter where I interview commercial real estate players. That means deal sponsors, it means syndicators, buyers, sellers, all that kind of stuff. And you might stop and think, why would you do that? And the answer is if you know about off-market private deals that you're not supposed to publicly discuss, then you know that the SEC requires that you have documentation of your prior substantive relationship, or else they'll get ants in their pants and it'll cost you in the business side. So we don't want that, and that's why I have people on here. The benefit to you for watching is you will not only learn how to more effectively communicate on the subject of commercial real estate deals, which at the end of the day, I think your career future in this industry is going to depend on that particular skill. But you'll also understand how my guest fits into these deals as well. But before we get too excited about real estate itself, Ryan, do you want to say a thing or two about yourself?
Sure. I apologize. I've been such a moving target to pin down here. I know we've been working on this for a while, but here we are. So live in the present, right?
Yeah.
I was a police officer for 24 years. So I was a state trooper in Ohio. Retired in December of 2022
Mhm.
to pursue real estate full time. We had been building that runway for about 4 years prior to retirement. Woke up one day and had an epiphany and realized that ride was going to end at some point. So we needed to figure out the next step. So we started putting the pieces in place and building a runway, and started growing our multifamily portfolio. And here we sit. So all roads lead to the day I got to be interviewed by Dan.
There you go. I love it. I love it. And after that glowing review, I'm sure that motivation is the first thing on our mind. Before that, though, I have to say, but wait, check your eight. Ryan, I don't know if you can do this or not, but maybe you can see through the camera and into the audience's device. They might have this hideous subscribe button down there, and they might want to, it's really unsightly. They might want to do something. Okay, it's a stupid joke, but whatever. Anyway, the five distinct motivations. I've now spoken to over 1,000 different commercial syndicators and deal sponsors and players in general in this space, and everybody does have their own unique why for why they're going to be doing these different deals. The reason why it's important to know what that is because these deals take months to close, they take years to go full cycle, and so you need to have some sort of idea why somebody is going to, actually follow through with what they say, and they're not just going to throw in the towel. And I found even though everybody has their own version of why they want to stick to commercial real estate, I find that they fit very neatly into these five different motivations. The first one is preservation of purchasing power. What on earth is that? Well, some people don't have to have a job. The way that they pay their bills is from the proceeds of their portfolio of assets. In other words, whatever profits come from ownership, that is how they pay their bills. So if you're already in a situation where you don't need to work, you might ask then why would you get involved in another deal that is it has these many risks involved and all of that sort of thing. And there are two main categories I've found. The first one is inflation when it rears its ugly head. Well, that's going to eat away from the purchasing power of your cash flow. So it's going to be time to make a new acquisition. And then the other one is when you can buy at a steep discount, which of course you should always attempt to do. You should always try to buy it at the cheapest price possible. But somebody in this position wouldn't pull the trigger until it's a real sweetheart deal. And that only is going to happen when there's distress or maybe an asset crash or something like that. And to tell you the truth, as far as my own motivations, I'm not far enough in my commercial real estate career where this is a main driver. Instead, my big one is trading time directly for wealth. And that comes from the fact that I've got a background in tech. Specifically, it was the CRM space, emailing 5 to 7 million emails a month, doing all of the different credit card transactions, those sorts of online funnels and marketing tech. And I got there because I was seeking a bigger and bigger salary. But when I started working for a real estate firm in Ohio, a guy who was doing 10 single family house transactions every single month, and he was making money hand over fist. And I got to go, well, hang on, I need to pivot where instead of seeking this bigger and bigger salary, I need to get rewarded in the form of little slivers of deployed capital, aka equity. So that's what I'm up to, and that's a little too abstract for a lot of youngsters. But the next motivation I have here, it's appealing to a lot of youngsters, which is they want to fast track their retirement by hustling like crazy right now. Now, there's more versions out there of this motivation. Like people want to work fewer months per year. They just want to control their schedule a little bit more. That's a major motivation for a lot of syndicators and people in this space. And one thing that's a spoiler alert is that a lot of people who are big proponents of this sort of thinking, they think that people are just in various phases of hiding the fact that this is what they actually want. But I assure you, that's simply not the case. There are some people who are fueled just by ambition. They want to buy their entire hometown. They want to make sure that their great grandchildren never have to hold a day job. And that's why they're hustling like crazy, and they're going to keep hustling into their 90s. Now, I know in some circles that sort of attitude, that sort of belief structure, it's vilified. But the fact is, if you want to make sure that properties are kept in good repair and businesses are running smoothly, then you need people like that who are going to be there day in and day out. And so that's why they're great people to have on a GP team. But the last group that also is similarly highly motivated, it's a byproduct of the fact that they've picked a sector of society, or maybe it's the environment, maybe it's animals. But regardless what it is, the main thing is they found out that there's a financial component to making a really big difference in the world. And so that's why they are building that portfolio, that high net worth, so that they can support that cause. Now, Ryan, what combination of those five would you say describes you best?
Well, I'm glad you gave me the option to have a combination because I definitely don't fit in any of those buckets singularly. Um, I'd love to buy my hometown, but unfortunately, I live in Columbus, Ohio, and it's the 14th largest city in the United States. So if I buy my hometown, you can come visit me on my island. But no, I definitely fast track retirement, I guess, is shades of it. For me, it's just more about the challenge and always kind of having something in front of you. I've been a high performer, throughout my law enforcement career, and idle hands are the devil's workshop. If I were just left to my own devices, I would definitely find a way to get myself into hot water. So I always need something to kind of channel my energy into, and my passions into, and real estate in general, multifamily specifically, has definitely presented that opportunity. I definitely also enjoy the help people aspect of it. I've actually set up a foundation for myself, and I flow 10% of my proceeds from my real estate ventures through this to help folks who have been disenfranchised and need a little leg up. But we've been blessed far beyond what we ever could deserve. So I believe that comes with a duty to give something back. So I fall into that bucket as well.
I love it. I love it. That's fantastic to hear. But of course, when we were finishing off talking about motivations, it's pretty easy to end up sounding overly optimistic, like everything's going to be all fluffy pillows and rainbows and all that kind of stuff. But this is a mature business, and every type of business has risks involved. Now, if you've ever been involved in one of the off-market private, they're sometimes called 506B syndications, then you probably had to fill out this, it's called a suitability questionnaire. It's all these invasive financial questions that the securities attorney involved should have insisted that every partner signs up. And if there was no securities attorney involved, then you should run. That's a red flag. Like, oh my God. But the when I was going through that questionnaire, when I was building it and filling it out and all that kind of stuff, I the one question that bothered me was the one about tolerance for risk. And the thing that bothered me is it lacked utility. In other words, I couldn't really take any of the options and really believe that I knew what somebody interprets as risky. So I made my own version that's a fill in the blanks question, and here it goes. It's there are many popular investment asset classes, but I think blank is too risky. So Ryan, it can be inside real estate, it can be outside real estate. You can give one of each if you want. But what's too risky for you to invest in?
Office. Uh, we're seeing it all over the country. You know, the COVID pandemic redefined the world as we know it, and I believe that the office leasing environment definitely fell victim to that. I, I think it's in stages of a comeback, but will it come back to what it was prior to the COVID pandemic and everyone, finding the right sweet spot for, work from home and telework and whatnot? I don't know that we'll ever get back to where it was. So for me right now, that's the space.
Mhm. I love it. I love it. And that brings me to the next question then, because that was more of a qualitative sort of question, and here's a more quantitative one. And I got to tell you, this slide here for the first couple hundred chance encounters, I did not include something like this, even though I really wanted to, because I wanted to make sure that if you're sharing a deal with my guest, then you're speaking their language, so to speak. Now, my hesitancy was because some people are more like public relations or marketing, like the front of house sort of role. They're not the deal sponsor. They're not the head honcho, so to speak, or honcha, I guess, if we're whatever. Anyway, the issue with the metrics, though, the reason why I came around to start including it is because even if you are front of house, you're going to have to do some sort of choosing between deals. And so there's going to be a few different metrics that they tend to zone in on to, pre-vet their different deals. And this is not an exhaustive list of them. There's 14 of them. And for anybody in the audience who's only listening and not watching, they are cash on cash, IRR, which is internal rate of return, cost per door, then there's net operating income or NOI, then there's going in cap rate, which more means how much of a discount are they getting for that area when it looks to the cap rate. Then there's the loan interest rate, especially important if you're going to be assuming a loan. Then there's the occupancy, which is just the inverse of vacancy. So it's the same thing, just inverse. But average income where the property is located, the amortization period of the loan, especially if you're going to be assuming it. Then there's the difference between the market and in-place rents. There's the population growth of the area. There's the sponsor record, which is how many deals have already gone full cycle and how many are on the go right now. Then there's the waterfall split or exit strategy, which it means what happens to your investment after your capital has been returned. And then there's the DSCR, which is the debt service coverage ratio, which means how much of the revenue from rents and whatnot is going straight out the door to the loan before it actually hits investors' pocketbooks. Now, of course, those that's not an exhaustive list, as I mentioned. So, Ryan, if there's some that I did not include, feel free to use them. But maybe you want to give like a top two, top three, something like that.
It's a kind of a broad brushstroke, I guess you would say, that encompasses a few of those. But to us, the most important thing are the growth metrics of a particular area. You can get a great cost per door, that meets all the DSCR requirements for the bank to lend on it. But if it's in a terrible area that's retracing, that risk profile of that investment opportunity is just astronomical. And for us, it's just not something that we would look at. We invest heavily in Southwest Ohio, Columbus, Cincinnati, and to a lesser extent, Dayton. But all of those markets are exhibiting just fantastic growth metrics. And then even we get a little more granular than that. We're looking to identify submarkets within that market that are actually within the path of progress. And we want to be able to map out a path for our investment opportunities that has a significant potential to be upside. You know, Nothing is safe, quote unquote, nothing is risk free, but we believe that buying and holding in the path of progress is the sweet spot in the risk metric for us and for our investment partners.
I love that. I love that because you're talking about baked in, supply and demand, simple concept. I'm just eating that up like a delicious subscribe sandwich. It's very subtle that I want what I'm actually aiming for people to do, but it's my little reminder to pull out the Dan Does Deals Commercial Core Competency Cube, and it's got the 6 different roles in a commercial real estate deal if it's not going to go under, and if while I'm going through the 6 different sides as briefly as I can, if you're thinking, wow, I really need to get me one of those, well, the good news is it's absolutely free. You can go to dandoesdeals.com and there's this great big button you can click on and you can print it out. And yes, I committed the cardinal sin of marketing, which is you should never ever give your freebie out without asking for some sort of contact information. But I did that because I understand how important it is that you learn how to effectively communicate on the subject of a commercial real estate deal and the different roles that go in it. But the best part, as I was mentioning, is you're also going to understand how my guest fits into those deals. And the first side that I go through is the repositioner side, and they are the most visible people in this business. You're more likely going to be meeting a repositioner than anything else. And what they're up to is they are the acquisitions people. They're looking through these hundreds of deals that are out there at any given time, and they're doing the math, they're doing the paperwork. They got to figure out, first of all, is this property even making the amount of money that the seller slash broker claims it is? Because okay, so they not only have to get a snapshot and a clear picture of what is happening right now, but they're called repositioners, or at least I call them repositioners, because they're figuring out how to change how the property is run to make more upside. And one of the most peculiar parts of being a repositioner is you need a wide network of financiers. So that is people who only deal with paper and money and the owners of the property. So they're not GPs, they're your different types of lenders and banks and whatnot. So the reason why the repositioners also all have to know tons and tons of financiers is because of cheap money. In other words, if you can find a more advantageous loan, then that'll go straight to the profitability of the building. And so that's why having those financier relations is so pivotal. But the first place that a repositioner will typically look to find some more upside, they'll also check to see if they can get some more efficient operations, see if they rents match what's going in the market in nearby properties. And of course, you may ask, see, if you do know about me, one thing you probably know is that I'm from the internet. And so the problem with that is, like, how am I going to be doing these commercial real estate deals? Well, as far as operations, my contributions have to do with social media and the web-based applications, different automations, different tech stuff. But the bigger one is, because the question comes out, especially with my own focus, which is 100 units or more, these bigger properties, the thing that you have to understand about real estate is that vacancy is the enemy. Vacancy is the deal killer. And so even if you have these bigger properties where you're outsourcing to a third party to do the actual property management, if you've got a bunch of vacant units, then somebody on your GP team needs to have some serious marketing chops. And that's what I contribute when I'm a GP on a building. But of course, there's only so much you can do on operations to make them more efficient, because after all, this is a very mature business. So of course, the next place the repositioner looks is to get a contractor team to do a value add. In other words, make the place nicer. And then that way, the future residents will be happy to pay more in rent than the previous ones because it's nicer. But if only things were that simple. You can spend endless amounts of money on contractors. You can go ahead and gold plate the toilets if that's your thing, but you're not going to get a return on investment. And then on top of that, you have to make sure that they're not dragging their heels and they're not using subpar materials and all that sort of stuff. And if you're sitting there thinking, but Dan, you're from the internet, how are you going to make sure that they're not ripping you off? Well, see, that's why I need locals, boots on the ground, people who live nearby, because if push comes to shove and I have to be there in an hour or two, I'd still be stuck at an airport. So you need somebody who's nearby who can make sure that the contractors are keeping the schedule, they're doing the right thing, the operators aren't giving you fake photos and reporting things that aren't actually based in reality. And it's just a beautiful thing. But what if you are considering becoming a repositioner? Maybe you're an engineer or a physician or an attorney or something like that, and you say to yourself, hey, I know how to buy a house. I just put down the deposit and I borrow the rest. And I bet you that 350 unit apartment complex down the road that has been catching my eye, I bet you if we pulled in like 100K each or something like that, I bet you we could take it over. Well, when you go to the financiers and say something along the lines of, hey, I want to buy that 350 unit apartment complex, it's tens of millions of dollars. You don't have, I don't know, say tens of millions of dollars. You want to run this?
Do you take a check?
Yeah, exactly. DJ, I left it in my other pants personally. But anyway, the beautiful thing, if you're in a mentorship program or if you have a guru or something like that, I highly encourage you to listen very carefully to this next part, because the financiers are going to say no unless they say, who's your sponsor? Who's the KP? What's that all about? So these different lenders, they have to be really, really sure that you're not going to take all of their depositors' money and then buy this property and then just run it into the ground. So what they're going to ask and require before you're eligible for a loan is that somebody who already owns a similar asset is involved in the deal. So in other words, if you want to buy a 350 unit apartment complex, you got to have somebody on the team who already owns a 350 unit apartment complex. On top of that, you need to produce a bit of liquidity like I was mentioning before. And then as far as collateral goes, you need a balance sheet, a bunch of net worth for collateral of at least the amount of the loan. But if you have all those pieces, you got yourself a commercial real estate deal. So Ryan, as far as those pieces of the puzzle, you're obviously a repositioner. You're obviously got a lot of boots on the ground because you're focusing in Ohio. But I don't want to put words in your mouth. Which boxes are you most likely to check?
Yeah, we would check the KP box also.
Excellent.
We've had opportunity to build up a multifamily portfolio and are operating it currently.
Sweet. So let's talk about the buy box then. So when real estate people are asking, hey, what you looking for? Well, we're really asking three main things. First one's geography. Where is it? Okay, it's which state, which city, county, even possibly which neighborhood. It's all going to matter. Okay, so that's location. The second one is size, and in multifamily, the way you define size is by the number of apartment units. And the reason why it's relevant is because the type of team that takes over 15 or 100 or 15 or 20 unit apartment complexes, they're not going to be the same fundamentally as a team who takes over the 150 150s and up and that sort of thing. So that size is definitely going to matter. Other types of commercial real estate, they go off of square footage or acreage, different things like that. But that size is going to matter for that exact reason. But the third thing is normally called class. I prefer the term desirability because it's more than just one thing. The two things it is in fact is the condition and the area. Okay, and when you're talking about condition, it's about how beat up is the building, how up to date is it, how many amenities and luxuries does it have. That's that part of the desirability. But when you're talking about the area, especially if you're talking about residential, like in multifamily, the school districts where the property is located is going to be very important. But every type of real estate is going to care about what the crime rate is like. So that's going to be something you want to check out. And then the other one, I go back to the old broker trope of saying location, location, location. What they really mean is traffic, traffic, traffic. If more people pass by a property every single day, then it's going to have higher desirability just for that reason. But both the area and the condition are ranked the same way as in grade school, where you have A plus at the top, and then A, and then A minus, and then B plus, and so on. But Ryan, as far as you and your buy box, you already mentioned the sections of Ohio, but there are some virtual assistants I know in the audience who are sitting there typing away whatever your answers are. So if you don't mind repeating yourself, please do.
Yeah, we're in Southwest Ohio, primarily Columbus and Cincinnati.
And then as far as unit count,
Uh, Obviously, we'll at five we're into the commercial space. I would look at probably something 25 and up. Um,
mhm,
I don't know that we've got the chops yet to do anything more than maybe 150, but
mhm.
anywhere in there.
All right, beautiful, beautiful. And then as far as the classes, you said you avoid war zones, right? So like D's out of the question. So, but like what sort of classes as far as the ratings?
Yeah, when we're considering an opportunity to buy an apartment complex, the class obviously matters. I wore a bulletproof vest for many, many years. I hung it up, and I don't want to have to put it back on to go visit my property. We avoid those type properties. We're B minus, C plus, where we have an opportunity to take some of the meat on the bone and generally move that scale up a notch.
hmm Yep, I love it. And so that brings us to people. And this is actually my favorite part of commercial real estate, especially coming from tech. It's not a secret. Tech people are fairly antisocial, and commercial real estate people are so eager to make introductions and referrals and that sort of thing. I chalk it up to the fact that because it's multifaceted, the fact is nobody's going to be all six sides of the of this cube here for any real amount of time, and so because of that we're all hunkering down on our couple sides or whatever it is and becoming great at that instead of spreading ourselves too thin. But because we all have our own unique skill sets as well, me with my CRM and web-based applications experience and e-commerce, the people who I tend to gravitate towards, am eager to meet more of, is the sponsor KPs, and that's of course because they've actually got a business together where a guy like me can make a disproportionately large difference. Whereas when you're first becoming a local or a repositioner, you need people who are putting in 80 to 120 hours a week, and that's just simply not where I'm at my biggest contribution. But of course, at the end of the day, everybody in this industry is in the business of deploying capital. So financiers are also people that everybody is eager to speak to. But on that note, Ryan, I don't know if you have any 506B deals going on right now, but if you do, make sure you don't mention them and being interested in investors in the same breath. But who's out there in the audience that you can help disproportionately more?
Yeah. No, we don't have any 506Bs open, so you're not going to see the SEC breaking down my door with ninja suits on while we're on the Zoom.
Yeah.
Um, no, I firmly believe that we have an obligation to help and to give back. Uh, whatever skill set or whatever knowledge base that we've been able to acquire. I strongly dislike, I'll say that for the Zoom call, the folks that gatekeep their knowledge and attempt to leverage it or monetize it somehow. We're all sitting here because other people gave us a leg up. I defy you to show me a person who was, quote unquote, self-made that didn't have, some opportunities or a boost from someone else along the way. And I strive to be that person. Others have helped me arrive at the place where I'm at, and anything I can do to be of assistance to others, my skill set, such as it is, I'm always happy to be an asset and to try to add value to their lives and their operations.
I absolutely love that answer. And of course, now I'm sure people are just dying to get in touch, but of course, I'll just sandbag that and talk about myself. Now, fortunately, I got this really distinct last name. It makes me really, really easy to find on LinkedIn, which is where I spend most of my social media time. And that's where I ended up meeting Ryan. And that's been really, really cool, especially with our emphasis on basically like being virtuous and our distaste and displeasure around people who rip each other off. But if you are interested and you're looking for some reading material, maybe you're going on vacation or something like that, you got a flight, I do have a few different books on Amazon.com that are all focused on different business related skill building. And so you can check those out. But if you are going to be getting involved in syndications, which is where you are selling passive interest, in other words, you're taking on passive investors and giving them some sort of returns, I highly encourage you. You can pause the video and scan this QR code because that goes to the FAQs page of 506 BME, which is the platform where we offer the IT and backup service for the documentation of your substantive relations with your investors. The idea being that if your laptop falls into the bathtub, the SEC is still going to need some documentation, or they're going to assume that you publicly solicited the different investors in your list, and they can shut you down, and that's no good. But Ryan, if people are out there in the audience, they should definitely connect with you on LinkedIn, I imagine. But as far as like website, phone, email, what's the best way to reach out to you?
I would say probably the best way to find me is on LinkedIn. I try to be fairly active and put myself out there, and it's a process. I worked for the last 10 years of my law enforcement career in a very covert role. If you saw me, I messed up somehow, and that's been a pretty significant challenge for me to overcome mentally as I, you know, move full time into the business world. But yeah, reach out to me on LinkedIn if there's something I can do to help you along. More than happy to do so.
All right, awesome. And so now that you've said that, I now have to give my public service announcement, which is if you've been watching this episode and experiencing like searing pains in your eyeball, like, and like migraine like symptoms, I'm confident it's because of the hideous subscribe button that's just down there, and you can get rid of it for free. And full disclosure, the reason why I encourage people so much to hit the subscribe button is because if enough people do, then YouTube will actually start to pay for these videos instead of me. And I think that would be amazing. And as far as you're concerned, as I mentioned, it's free, but the trade-off is that my videos may show up on your list of suggestions. But quite frankly, you can go ahead and ignore those suggestions because I just appreciate the fact that you spent this time with me. Just like Ryan, I appreciate you joining me. This has been great.
Yeah, absolutely happy to do so. I apologize it's taken us so long, but we're here now. So
No problem, man. Awesome. Hey there. Are you interested in commercial real estate deals? Would you like to build your network of investors and deal sponsors? Well, the best thing I can do for you is have you appear on a chance encounter interview as featured on dandoesdeals.com. You may know me from 506 BME or as a top commercial real estate voice on LinkedIn. And if I had to think of the top factors in your success in commercial real estate, my top two would be your network and your ability to effectively explain how deals work with effective communication. The 15-minute chance encounter format It checks both of those boxes, and they ensure that you can share your private deals with me without the SEC calling it a public solicitation. So hop onto LinkedIn. You can see my name is over here, Dan Friedenberg, and search for my name. And the best way to reach me and book that is to message me through LinkedIn. And don't worry, it doesn't matter if you decided to enter this space just last week or 2 weeks ago, or if it was decades ago. It'll be fun and easy to look good. We're just asking multiple choice questions based on your core competencies you look to contribute, your level of sophistication, and all that kind of stuff. So I hope to hear from you soon. Thanks a lot. Make sure you 506B me. Any syndicators, make sure you 506B me.
Hi.
Oh, hey, yeah, here's my code. You got your QR code scanner? Okay, yeah, oh yeah, just hold it right in the square there. Okay, cool. And now you hit open in browser.
Okay.
Okay, are you already logged into 506B me?
Yes.
Yeah, okay, cool. Yeah, so there's my video. So now I'm already on your watch list. So when you get back to your hotel, you can find out what my core competencies are and my level of sophistication. Sound good?
Yeah.
I love your hat. Real estate's a scam. That's really funny.
Yeah.
Nice meeting you.
You too.
506B me, everybody.